Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here since 2003 for individual traders and professional institutions, which I consult with weekly. Okay, let's get started here. This is my back-end newsletter recorder for the website, so let's go ahead and get that started. Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone's had a nice weekend so far. It's Sunday afternoon, and futures market's probably looks like it's going to open about 15 minutes, so I'll let you know where futures are. But anyway, this is the comprehensive weekend newsletter for Breakpoint Trades for Sunday, March 26th, 2023. Newsletter is divided into 7 major sections. Again, if you happen to be new here, these newsletters are quite comprehensive, especially on the weekend. We do a top-down approach on the general market, indexes, we look at various news, market indicators, we examine most of the sector charts, we look extensively at many of the commodity charts, bonds and interest rates, currencies, US dollar, and of course precious metals. All right. Now, last week, the major indexes did manage to close up for the week with the S&P gaining 1.4%, Nasdaq gaining about 2%, Russell 2000 small caps about 0.7%. As you know, last week the Fed raised their overnight rates by a quarter of a point to now 4.75 to 5%, which was widely expected. Okay. Again, guys, I will point out that the fact that you can now get up to 4 to 4.5% return in a money market, you can get 5% or more on bank CDs and treasuries. Over time, that is ultimately going to take money away from the market. Okay, supply from the market. Example I saw a couple weeks ago was, let's say you had $10 million in treasuries a year ago. And I know $10 million to a lot of you might sound like a lot of money, but there's a lot of wealthy people out there that, $10 million is pretty common. So if you had a year ago, if you had $10 million in treasuries, you made about $70,000 in a year in interest. Now, with that same 10 million, you make 500,000. So think about it. If you're someone maybe inherited some money or whatever, you sold a business, you got $10 million. Before where you felt like you had to have that money into the stock market to get some return, maybe you're happy with that 500,000 a year. You can live on that and you don't need to risk it in the market. So that's something to think about over time is, when interest rates were set at near 0%, that forced all the money into the market for folks to try to get a return and fueled a lot of those speculative excess bubbles. And we don't have that now. And I don't think the Fed could easily go back to just lowering rates and go back to a QE, okay? The other things last week, there's a lot of crosswinds on the markets. So I'm going to keep it pretty simple this weekend. I'm not seeing anything really standing out. So we're just going to look at the charts. I'll comment on what I'm seeing here, but I'm not seeing anything that, man, really stands out here. I will say that, one thing that's not healthy is that we're having very few stocks lead this market rally. For example, Microsoft, Nvidia, Apple, they make up 50% of the XLK technology ETF. And I'm seeing a lot of these breadth indicators that have fallen through the floor while the indexes hold up. That's because, again, few stocks are leading where the vast majority of stocks are underperforming or down. Okay, that needs to change for this market to continue holding up or to rally sustainably. My other observation is that when I run my scans for long trade ideas, I could hardly find any good actionable ideas. Usually when things are really good, I have tons of setups, 10 or 20 long setups I can put out. I don't have that this weekend. I have a few subpar setups. So that concerns me a little bit. Other things, last week, banks and financials, of course, got very oversold, and they did bounce late in the week. They could perhaps be due for more reversion to mean, as long as we don't see anything blow up or any more bad news, which again is obviously possible. A couple things this coming week, Friday, the PCE, that's important. And of course, the important range for ES futures, 39.30 to 40.70. Okay. If those ranges are broken, we could see a big trending move in either direction. up or down. Next. Item number 2 shows the index sector table, what transpired last Friday and for the week. Again, you can see Friday the indexes were up around 0.5%. For the week, they did manage to gain anywhere from 0.7% to around 2%. As far as the major market sectors, the 21 we follow, mostly up, a few down, but nothing really down that much. Market held up decently. Currencies, US dollar, down 0.6% for the week. Cryptocurrencies were kind of mixed. Commodities, all mostly to the upside here with that falling dollar. Wheat was down, but that's pretty much about it. Well, gold was slightly down as well. Gold has had one heck of a rally, and it's getting a bit overbought here, so not surprised to see that. Silver still had a decent week. The stocks, they had a decent week. The stocks have been leading. Again, a lot of money rotated in that area because of the dollar falling, but also fear trade. But I do believe longer term, that area could see significant gains. But if the market does start rally here, we don't have any negative news, we could see some money rotate out of the gold for a short term. Again, all the other commodities are up here. Crude oil, decent week, 3.5%. Copper up 4.7%. Next, item number 3 shows the economic news calendar for this week. Again, the big one for the week is that PCE on Friday, and you have the Chicago PMI. And of course, anything that could come out of left field from the banks or the Fed or Janet Yellen or whatever. All right, let's go and move to some charts. So this first image below, item number 4, this is taken from the Fed website. This is the Fed total assets. As you know, once they ended that QE, they started unwinding assets, and they were doing a steady Eddie job, as you can see there. And then lo and behold, in the last 2 weeks, they've given back, year and a half worth of work. Okay. So that's very disheartening to see that, and it shows you how vulnerable things are too, guys, with this in the system. But the fact that they were slowly reducing the assets, and again, within 2 weeks, they've already taken out half of that work. It's kind of the analogy I like to use is you have a trader out there, he's making consistent profits, booking profits, he's taken like 50 trades, and then all of a sudden in 2 trades he gives back most of his gains that he took 50 trades to do. That's kind of what this is. The other thing that guys to consider is Fed is not going to go back to QE anytime. That would cause rampant inflation and other things. But a lot of the, this activity we're seeing with the banks and everything else, shoring up things, that is sort of like a QE. It's injecting money into the system to keep it going. Next. Image number 5. We showed this last week as well. Doesn't look like it changed. This is the percentage of domestic banks, the tightening standards for commercial industrial loans. And you can see how the banks have really, really tightened things up. The last time they did that was in February, March 2020, but the Fed came in with the helicopters to drop as much money as possible, so that quickly came down and was averted. We're not in shape now to do something like that because, again, we're trying to get inflation under control. And if they did something similar like they did in 2020, we would see rampant inflation. Does anyone want 20, 30% inflation just to get the stock market up? I don't think so. But you can see in the past when these banks tightening standards went up, again, if you take out that outlier of 2020, look at 2008, look at 2001, 2002, those were in bear markets. And so that's where we're at now. Next. Let's go ahead and move back to the charts, the index charts. So we're going to look at, this is a monthly view of the major indexes. So each candlestick is 1 month. And these go back to 2008, 2009. So you can see the beginning of that bull market. And as you know, we had that, what I call a classic blow off to that previous bull market when the run up from the 2020 lows to late 2021. Again, you can just see the slope degree change in that previous bear market that you had previously. So we identified our markets entering a bear market in late 2021, early 2022, and that was the correct call, especially last year. This year it's been more choppy. We've rallied up, but again, bear markets don't go straight down, guys. Bear markets are usually some sort of three wave. I can see here if I'm just going to the Dow, I could see potentially wave one, two, maybe needs a third wave over time. But again, this is going to take time to play out. These uptrend lines you could see from the 2008, 2009 lows. I think over time these could be tested, but again, not anytime soon. Maybe they aren't tested for a year or more, but I think eventually they could be. The S&P, you could see, been stalling at its middle Bollinger Band, which is typical in bear markets. Next, chart number 7. Here's a weekly view of the indexes. So you can see we had that doji candle last week on the Dow. Was set up for a bounce condition, which we got price stalled at the 9-week EMA. You can see on the S&P, broke this little wedge, undercut that downtrend line, regained it, and last week's rally tested that broken trend line as resistance. And of course, the Russell at the bottom broke down. Next, chart number 8 here is the daily view of the indexes. So the Dow at the top, you can see that previous support became resistance. Here I added downtrend lines to monitor. In the S&P, if it can clear that downtrend line, that would be a positive. The Nasdaq area, of course, has been leading. It's mainly a few stocks that are causing that too. But you can see the Nasdaq 100, they broke their trend lines a couple weeks ago. The Russell, trying to lose this support, regained it on Friday. Now there is some positive divergence there that it could try to build on, which I'll cover when we get to the Russell. Next, let's go and move to the S&P charts. So chart number 9 shows a monthly view of the S&P 500. Just shows you the bigger picture. Again, I've shown this chart many times. You can see the previous bull and bear markets. We stalled at late 2021 at the top of this channel, which we identified as the end of that bull market, which so far has been correct. The middle Bollinger Band's 20-month moving average has been acting as resistance here. I do expect the S&P over time to at least test this uptrend channel, which goes back to the 2009 lows. If not, test one of these fibs below, like the 38% fib, 50% fib, but again, over time, later on in this bear market, not now. And of course, the 14 stochastic here has done a great job longer term, identifying bear and bull trends. In bull markets, the 14 stochastic tends to find support at the 50% area. As you can see, in bear markets, it falls below it, and that occurred last year. Next. Chart number 10, here's another simple chart, another monthly chart of the S&P. This one uses the 8 and 13 exponential moving averages. Those are two fib numbers. And again, this isn't perfect. It's not something I would use as signals, but overall it's done a pretty good job at catching trends. So you can see whenever the 8 EMA falls below the 13, tends to identify bear market trends in late 2020 or late 2000, early 2008. And then of course, in that 2009 low, all those years, the 8 EMA never crossed below the 13 EMA. It got close, it pinched a few times, but never crossed. It crossed last year, and you can see it's been remaining so. Good overall trend guide. Next, chart number 11, here's a weekly view of the S&P. Again, when we're showing this downtrend line from the January 2022 highs, we lost it a couple weeks ago. We regained it, as you can see. I added another downtrend line to monitor here via this. And if the market really wanted to rally, some of these upper fibs could still be targets. Again, overall, we still view this as a bear market rally. All right. Another thing to monitor is this trend line on the RSI 14. It still continues to hold. Even on that last sell-off, it held. But if this were to break, that would be something that would be bearish. So below here, the 60 stochastic, that 50% area, still acting as resistance. But, if the market holds up, maybe it'll try to break it this time. We'll see. Next, moving on to the shorter time frames, chart number 12, here's a daily view. Okay. So first off, we found support and at the demand zone a couple weeks ago. We rallied up to the 50-day moving average downtrend lines. We stalled there, and a nice rally recovery on Friday. Again, notice I got an uptrend line here to monitor. I would like to see that hold if the market's going to push up. And I left this downtrend line here in place, and here's your other downtrend line. So those are the things to watch. On the positive side, notice the trend line on the 14 RSI. Remember I said drawing trend lines on the RSI 14 can give you very objective signals. And we did get a positive break a week ago, and so that's one for the bulls. See what else we got here. The 60 stochastic is still below 50% though, so we do need to see that get back above there for confirmation as well. Next, chart number 13. Here's a clean daily view of the S&P. We have a kind of a coil setup here. Not a traditional coil because you don't have enough touches, but you can see kind of a symmetrical type triangle. And here you got another coil developing within the pattern. So energy is built up here. And if you look at the top here, again, drawing trend lines on this 14 RSI has given excellent signals. You can see the trend line break here, gave a nice sell signal there in August last year. It was very timely. Then you had a positive trend line break there in October. That gave a nice buy signal down there at those lows. You had a negative break there in November. That was another little sell signal. Then you had a positive break in January, and you had a negative break there in early February, and you've had a positive break here. So far we do that is a positive here. The fact that that is broken again. Now we want to see price hold this lower uptrend line inside the bigger coil, and we want to see it break out. If you're long here, I think you could have a stop essentially at Friday's lows. Next. Chart number 14, here's the S&P. Steve showed this last week with the S&P equal weighted ratio below. And again, this is one of the comments we pointed out is that, the problem with the market right now, and this needs to change for it to be healthy, we need to see some of the other stocks participating instead of just the large cap stocks like Apple and Microsoft. So you can see how this just absolutely fell off a cliff here. But the S&P didn't decline much here. That was a small decline from here to here in March, the first couple of weeks, but this fell off of the cliff. So again, that shows you that, when you equal weight the 500 stocks in the S&P relative to each other, many of the individual stocks got hammered while the index didn't. Again, that's because of the weighting. And you do have a little negative divergence here with this ratio had formed a lower low compared to the S&P, so that's concerning. Next, chart number 15. Here's the daily KISS trend system. Now in the S&P, this did not go back long yet. It's still flat. It is long on the Qs. It's been flat since February when the last smart trailing stop was hit up around 39.90. You can see the last time the moving average ribbon pinched on the bearish side gave you a nice short. Right now, it's close to going positive. Next. Chart number 16, here's the weekly KISS trend system. It's been long, as you know, for, since January, essentially. But no changes here. It's still long. The positive is we did break that ATR, which is now support. And we'll see. Next. Chart number 17, here's the 4 time frames we like to follow. The daily chart is the upper left here. We stalled at that ATR last week. We had resistance cycle on the half day, which so far is capped price. We are above the ATR. You can see the cycles have been doing a pretty good job lately with the price. It caught the low a couple weeks ago, caught the recent high. 130 minute, we're holding an ATR. The stochastic holding that 50% area. And we have a cycle support there trying to cradle support. Next. Chart number 18, here's a 2-hour review of SPY ETF. We're showing the ETF because stock charts is still missing data from their cash S&P. But I went ahead and left this downtrend liner even though we had that Pinocchio move above it. This is still something to watch coming in this week. If we can break that or not, form a higher low here. Next, chart number 19, here's a 60-minute view. We had that little rising wedge we talked about early last week, which again provided a quick, sharp move down when we did hold this uptrend line, and we rallied over the last day or so, a couple days. So again, if you're long here, you could have a stop right there. Next, chart number 20, here's a 15-minute view. In Steve's newsletter on Thursday last week, he identified the falling wedge here, and that did produce a move up on Friday for a trade. Next, moving on to the triple Qs, chart number 21, Q weekly chart up 2% for the week. As you know, this broke over its weekly downtrend line back in early January. It's been holding out of there so far. Moving average ribbon, it went positive. Still looking okay. Next, chart number 22, here's the daily triple Qs. Again, money's been hiding out here. It's held up the best. You got a very clear buy signal on the RSI trend line break here, right where you see this vertical line in March 13th, 14th, whatever date that was. You can see very objective entry on that trend line break. Just like you get an objective sell signal on that RSI trend line break there in early February. So nice move up here. Again, this looks very healthy. The only issue is you have a few of these stocks leading the whole thing. Next, chart number 23, here's a 2-hour view. We had this clean channel. Once you broke that channel over a week ago, that was a signal to go long. Next, chart number 24, here's a 30-minute view. Next, chart number 25, here's the daily KISS trend system. As you know, this went long a couple weeks ago. You could see the vertical line where it went long. It still has not raised its smart trailing stop. I saw last week that it tried to raise it a couple times intraday, but the close is what matters. If we do get some upside move this week, we will see a new higher low stop come into place. But everything was set up there. Moving average ribbons were pinched. You had the BPTMA turned green there. So everything was set up for a bounce. The stochastic, 60 stochastic found support at the 50% area. Next, chart number 26, here's the 4 time frames we like to follow. Again, last week on the daily, we held that support cycle. You could see the dots. On the 195, we had some A's. On the 130-minute, and price did pull back a little bit from there, but we still have support at the ATR and on the 60-minute or 78-minute shorter time frame, we have the ATR resistance. Next, chart number 27. So here's the 3 major stocks by weighting in the Nasdaq or Qs and the XLK ETF. So NVIDIA here, you can see this is the KISS system. KISS system's done a good job. It went long there in January and just continues to hold the thing. Look at all these smart trailing stops that it put in place. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 times it's raised its stop. Good job by the system. Next, chart number 28, here's Microsoft. Same deal, went long back here in basically February 1st. It did not stop out here. So this low didn't quite hit that smart trailing stop. And it's been able to raise its stop here 5 times. Finally, chart number 29, Apple. So it's also went long back there in January, and you can see all the smart trailing stops. So it's done a good job here. You can see the Apple KISS system got out in August last year. It did have a little whipsaw there in October, then it got out. But it's done a good job here. But again, guys, I'm showing you these because these are what are leading the tech area. Okay, for a healthy market, we need to see more than just these stocks lead. Next, chart number 30, here's IWM Russell 2000. This area is absolutely pummeled. Small caps. So you can see big sell-off last week. You still have the support here. This is also exacerbated by the banks. Next, chart number 31, IWM on the daily. Again, we pointed out that double top. This is a weekly chart, I'm sorry. We pointed out the double top back there in January, which obviously played out. That's your longer term support below. Next, chart 32, here's the daily chart. So we did undercut the shelf support on Friday, but we regained it. What you have here, you have some RSI divergence on the, as you can see, and some CCI divergence. So you do have some positive divergence here, as long as there's no negative news that the market could try to bounce from. We'll see if it can do that or not. Let me do a quick check on futures. So tonight, futures are up about 14 points so far, it seems. Next. Moving on to some indicators, chart number 33, here's the VIX. As you know, the VIX was outside its Bollinger Bands back there in early March, came back inside the upper Bollinger Bands. That was a buy signal. And so far, that one is an objective long trigger on the S&P. It's firmly right in the middle of its Bollinger Bands. Next, chart number 34, here's the NYUD, NYSE advanced decline. Again, as we've been showing, we do have quite a bit negative breadth here. You can see the S&P making a higher high, this indicator making a lower high. Again, it's very few stocks are participating in this market rally, just some of the big cap tech stocks. We need to see that change. You can see the last time we had a divergence was in late 2021 before the market high. Right now we have the opposite. Next, chart number 35, here's the S&P and that equal weighted S&P ratio. You can have the same thing here short term. That ratio made a lower low. We have a higher low in the index. Usually the ratio leads, just like back here in October. The ratio had made a higher low versus a lower low in the S&P. That was a low. You had a high back. So it usually leads. Just like here in February, the ratio had a lower high to the S&P's higher high. So we'll see. Is this going to drag the index down or not? We'll see. You know, this could be negated if it recovers. Next. Chart number 36, here's the S&P versus the S&P bullish percent index. Someone asked me about this. I'm not seeing any divergences here. It's basically following along with price. So here's the downtrend line on the index to watch on a rally. Next. Chart number 37, here's the S&P versus the inverse S&P XLP ratio. They move together. We also not seeing any divergence here either. Going to keep an eye on this as well for confirmation. You can notice you can draw the same downtrend line on the index and the ratio. Next, chart number 38, here's the bullish percent index S&P with the two moving averages, the 9 and 20. This is also a guide to watch. We're still below that. Gave a great sell signal there in February, as you can see. Next, chart number 39, here's the Nasdaq with the 52-week highs minus lows at the top. And this is still quite negative. Again, what it shows you is the fact that the Nasdaq, you know, has had a good rally. A lot of the underlying stocks have not participated. Next, chart number 40, here's a positive chart indicator. So this is the S&P versus the value line. Actually, it's not a positive. So this has the value line has a lower low. The S&P has a higher low. Next, chart number 41. Here's the S&P large cap advanced decline versus the small cap, and you can also see the divergence between the two here. Okay. Again, these divergences, you typically, when you got these, they marked decent highs and lows. Is this going to mark a low this time? We'll see. All right, guys, let's move on to look at some indicators. Some of the market sectors. So chart number 42, here's XLK technology, and I just discussed this. Take a look right. You can see the chart's holding up well. We're well above its Bollinger Band and the 9 EMA, but look, Apple makes up 22%, Microsoft 22%, Nvidia 7%. Three stocks of this ETF make up 52%. To me, the ETF's almost useless if three stocks make up half of it. But again, that also shows you what's going on in the market. It's the few technology stocks that are holding these indexes up. Next, chart number 43, semiconductors. They've been holding up very well lately, but Nvidia and AMD are big components in there. Next, chart 44. Transports, they've been weak here. We do have a little RSI divergence though, just to be aware of. But, clearly broke that shelf support a few weeks back. Next, chart 45, financials, as you know, they've had a waterfall decline here. The positive short term, if we don't get any big news, is we do have some RSI divergence. The ribbon is wide, and I can count 5 waves down now. Okay, so along with that divergence, this area could be set up for a decent reversion to mean type rally. Next, chart 46, banks, same deal. You have the same look to it. Next, chart 47, KRE, the regional bank ETF, as you know, that area really got hammered. But again, you have the same thing. Quite a bit of divergence here, wide ribbons. These could be set for reversion to mean if we don't get any negative news this week. Next, chart 48, here's the KRE KISS chart using this STS Smart Trailing Stop. This would have protected you, got you out back in late February, avoided that decline. Again, you can see we had a DeMark 13, ribbons are wide, so everything's set up for a potential bounce as we're so oversold stretched. Next, moving on to some other sectors, chart 49, here's materials, bouncing back to the 200-day moving average after losing that big shelf support recently. Next, chart 50, retail, little bounce. We do have some RSI divergence here. Oh, we do have that trend line break on the RSI, so that's a positive. Next, chart 51, XLP, consumer staples, nice rally on Friday. This trend line you can monitor. Next, chart 52, utilities, once again rallied off this lower trend line support. We also had a MACD KISS stochastic oversold setup there. Next, chart 53, healthcare, also rallied, but no changes overall in the bigger pattern. Next, chart 54, XLE energy. As you know, this area also has been weak. It was one of the strongest sectors last year, been weak this year. Well below its 200-day moving average. The last rally stalled there. Next, chart 55, oil services, same deal. Now, it is near some support here. We do have some divergence. Let's look at a bigger picture chart. Chart 56, here's a weekly view. Now, this is a logarithmic chart. We are nearing this weekly uptrend line. So definitely an area to watch to see if they can find some support. Next, chart 57, here's the S&P versus emerging markets. Just to see how they are looking. Emerging markets outperformed in October, but they really got hammered the last couple months with a strong dollar. You can see last week they rallied. We do have a little symmetry break here. That's a positive. Next, chart 58. Here's the S&P versus high yield corporate. Overall, not seeing any real divergences here. Next, moving on to commodities, chart 59, DBC. This is the commodity index. You can see it was up 1.25% last week. The previous week, it broke that support from that coil, so a little bounce back this week. No changes otherwise, technically. Next, chart 60, here's the daily view. Again, it broke that shelf support, which is now potentially resistance. Next, chart 61, crude oil had a huge breakdown last week to the 200-week moving average. That's an important area where price is trying to defend it here. Next, chart 62, crude oil on the daily. You can see, again, we broke that coil a couple weeks ago, which we pointed out was a good quick short. We've rallied and back tested previous breakdown area, which is now resistance. Next, chart 63, natural gas weekly view, up about 1% for the week. One hell of a sell-off starting from mid last year, as you know. We did have a reversion to mean back near the 9 EMA about a month ago. We've pulled back quite a bit since then. Next, chart 64, here's a daily chart. You do have potential double bottom setup here. Again, we'll see if it can break out of this or not, but I am watching this for potential long here if we can get a break. Next, Charter 65 Boyle, that's the 2-time ETF. So here you got a nice little downtrend line to monitor as a trigger. Again, natural gas is not an easy trader, guys. They call it the widowmaker, so be careful with it. Not the easiest trader, but I'm watching to see if this can break or not for a long. Next, Charter 66 Copper, nice up week. Sort of looking like a bull flag now here on the weekly. Next, Charter 67, here's the daily. Rallied off that support of that channel over a week ago, now back up to resistance. Next, Charter 68 DBA, slightly up for the week. Again, honestly, it's just been going sideways for the last, 10 months or so. Next, Charter 69, here's the daily chart. We did have some RSI divergence late last week. Nice rally on Friday. But back to these moving averages here. All right, let's move on to bonds. Charter 20, here's TLT, 20-year bonds, weekly view. We identified this as the demand support zone about a month ago, and price did indeed rally off of there. Keep an eye on it here. Moving average ribbons pinching, so this is kind of an important area. Next, Charter 71, here's the daily chart. So we did hold this on this pullback. We did hold these moving averages, which I said would be support. Next, Charter 72, here's the daily KISS system for TLT. You can see it is long. It's been long for a couple weeks. It's got another second trailing stop here. Price isn't really doing much. It's more chopping around here, so the stop's still pretty wide. Next, Charter 73, here's the 10-year Treasury yield back down to this lower area, which is potentially support. We'll see. Next, Charter 74, here's the daily chart. Broke a little trend line support here, back tested it on Friday, which is a resistance. Next, Charter 75, here's the yield curve. This is the 10-year divided by the 2-year. And as you know, this went negative early last year. But the reason I'm showing it is because look at how much it's rallied here recently. Last week it was up almost 9.5%. It's come back pretty much. It's still inverted here. But I'm showing this, guys, because a lot of times it's not when the curve is inverted when you have your recessions, but after it comes back above the inverted area. That's usually when you get your recession. So again, guys, to me, a recession is coming. To me, it's all basically inevitable. So we'll see how deep it is, but the fact that the curve is starting to go up may be signaling that. Next, Charter 76, here's high yield corporate. They're still holding up here okay. The previous rally, month ago stalled at the 61 fib. Next, Charter 77 Bitcoin. You can see it was essentially pretty flat for the week. Obviously that falling wedge from early in the year played out. Next, Charter 78, here's the daily view. This boxed in area is a supply zone, so that's an area where price could work up into. Next, Charter 79 US dollar pulled back. You can see it pulled back from that moving average ribbon pinch a month ago. You got a potential little head and shoulder look here. It's not symmetrical really, but you can see this little shelf support. Next, Charter 80, here's the dollar on the daily chart. Again, had a little wedge into February, rallied up, has sold off. So, little bounce on Friday. Next, moving to precious metals, which had a great month. So Charter 81, here's gold on the monthly, up 8%. It briefly went over 2,000. Again, this is the pattern I've had in place for a while. This potential ABC correction, well, fourth wave, and we're in a fifth wave. If this is a true fifth wave, gold will eventually break out over the 2020 highs, go well into the 2000s, 2,500 or 3,000, whatever. We'll see if that ends up playing out or not. Next, Charter 82, here's the weekly chart. Again, gold for the week was just managed to close with a doji. Next, Charter 83, here's the daily chart of gold. Again, nice rally off that November lows, and of course recently. You can see we did briefly get over 2,000 last week. Got a little overbought. Next, chart 84, here's the daily ETF GLD. You can see we got into the supply zone where price filled it and then pulled back on Friday. Should the general market rally, we may see some of this money come out of gold because we did get money flowing into there because of the fear trade. Next, chart 85, here's the gold KISS chart. Again, this did a good job about going long here in early March. It now has 3 higher low stops. The last one is at 176.40. We had a mark 9 here last week, so getting a little overbought. You can see the ribbons got kind of wide. You had some divergence here on the derivative as well. Next, chart 86, another daily chart. This shows the gold with the GDX GLD ratio, and the positive here is that the stocks have been leading here since the trend line break there in early March. Next, chart 87, here's another gold chart. This one has the silver gold ratio, and that's also been leading as well. Next, chart 88, here's silver, weekly view, could be forming a big coil perhaps. And notice how silver bounced off that demand zone. We drew that back in place last year. Did a pretty good job about that. Price held that in August. Next, chart 89, here's silver. Again, that wedge played out beautifully. Next, chart 90, GDX weekly view. As you know, the rally stalled in January perfectly at the 61 fib. But notice what happened. The moving average ribbon had flipped from a bearish configuration to a bullish configuration, then pulled back and had that first pinch squeeze. Those are your high probability areas to look for a reversal, and that's what we got over the last month or so. Next, chart 91, here's the daily chart. Nice rally, and also notice the trend lines in the 14 RSI. You had a nice sell signal there in early February. Then you had a buy signal there on that recent trend line break. Both playing out. Next, chart 92, there's the daily chart with the GDX GLD ratio. The ratio has been leading. Again, you want to see the stocks leading, not the metal. The dotted purple line represents your higher low stops, one where you could potentially have you'd be long with a stop. So I would just trail stops a little below the 90 MA at this point. Next, chart 93, here's the daily KISS trend system. This also went long a couple weeks ago. Had a great entry there. So far, it's got 2 higher low stops. I'd like to see another one. Stop's still pretty wide from current prices. You might be asking me, how can I see these KISS charts? We have them on the website, guys, in the systems area. Go look and you'll see something called KISS Trend STS tables. They're right on the website. Next, looking at a few individual names, chart 94, GFI Goldfields was one I mentioned over a week ago, and this puppy just went straight up. I wouldn't chase it here, guys, but man, that's a heck of a V move over the last couple months. Next, chart 95, OR. This is one I identified a couple weeks back as a long in this area, and look how well it's done. Next, chart 96, DRD, another one I liked, cup and handle. That's also been doing well. Next, chart 97, Dundee Precious Metals, another one I identified, gave a trade. Next, chart 98, AI. As you know, AI has been all the rage lately. It's going to take over everything, but this gave a great trade. This is one I identified last Monday. It's going to be a great trade through there, as you can see. Next, chart 99, BABA was another trade idea from early last week. They gave a long, nice move. And the final chart 100, AQN. Here's a long idea, little base here to monitor. But as I said in my opening comments, guys, my long setup scans are not producing a lot of objective long ideas. They're just not. Again, part of that is because we just have a few stocks leading this market rally, and so we're not seeing many good objective trade setups. So no reason to force the issue. All right, guys, that'll do it. We'll see what happens this week. Enjoy the rest of your Sunday evening. Take care.